All right, let's talk about something that sounds super complicated but is actually built on some pretty simple ideas. We're going to break down options trading, and I promise we're going to make it make sense.
So, have you ever heard something like this? The idea that a stock can barely move, just a little 5% jump, and somehow your investment could shoot up by 200%? It sounds wild, right? Almost impossible.
Well, how does that actually work? That's the million-dollar question. And no, it's not magic, and you don't need to be a Wall Street genius. It's all about a specific financial tool. And by the end of this, you'll get exactly how it's possible. Okay, so let's start at square one. We've got to understand the basic building block of all this. So, what even is an option? At its core, an option is really just a special kind of contract. The key phrase here is the right, but not the obligation. Think of it like putting a hold on a concert ticket. You pay a small fee to have the right to buy that ticket at today's price next month. If the show sells out and prices go crazy, you can still buy it at the cheap price. But if a better concert comes along, you're not forced to buy it. You can just let your hold expire. That little difference is everything. And look, the cool thing is you don't need to learn 100 different types to get started. It really just boils down to two. If you think a stock is going to go up, you're looking at a call option. If you're betting it's going to go down, you're interested in a put option. That's it. Are you bullish or are you bearish? It starts with that simple choice. Right, so no matter if you're betting up or down, every single one of these option contracts is made from the same four key ingredients. It's kind of like a recipe. Get these four things down and you'll understand what makes up every option out there. So, here they are. First, of course, you've got the stock itself, Apple, Tesla, whatever it is. Second is the strike price. That's that pre-agreed, locked-in price we talked about. Third, the expiration date. Every contract has a deadline. And finally, number four is the premium. That's simply what the contract costs you. Okay, theory is great, but a real-world example makes it all click. Let's imagine Apple stock is trading at $100 a share right now. You think it's going to go up, so you buy a call option. Your contract has a strike price of $105. It expires in 1 month, and you paid a premium of $3 for it. So what does that mean? It means you now have the right to buy Apple at $105 anytime in the next month, even if the actual stock price skyrockets to, say, $120. You know, the easiest way to think about that premium, that $3 in our example, is as a non-refundable reservation fee. You paid for the opportunity, for the option to buy that stock at a set price. Whether you end up using that right or not, that fee is gone. It was the price of admission. Okay, now this is the part that can feel a little tricky, but stick with me, because this is where all the action happens. Why does the price of that contract, the premium, go up and down? What are the forces that are moving it? So, while there are a few things that can push an options price around, we really only need to worry about the big three to get started. The first and most important is, of course, the stock's price. The other two are time and a concept called volatility. If you can wrap your head around just these three, you'll understand most of what's going on. Let's talk about time. Time is, and I'm not exaggerating here, the silent killer of an option's value. Think of your option like a melting ice cube sitting on the counter. Every single day that goes by, a little piece of its value just vanishes into thin air. If the stock doesn't move your way fast enough, that option's value can literally melt down to zero. That's called time decay. And then there's volatility. This one's kind of the hidden force in the equation. It's not about how much a stock moved in the past, it's about how much the market thinks it's going to move in the future. So, if a big earnings report is coming up and everyone expects a massive price swing, guess what? The options get way more expensive because you're paying for a ticket to a much more exciting and potentially profitable show. So all of this gets baked into the price of the option in two parts. You've got what's called intrinsic value. That's the real tangible value it has right now. And then you have extrinsic value, which let's just call it hope value. It's the value of time, of volatility. It's the value of what could happen. And as that expiration date gets closer, that melting ice cube of time decay eats away at that hope value. All right, so now we get to the really exciting part. How do all these pieces, the stock price, the time, the hope value, how do they lead to those mind-blowing returns we talked about at the start? It all comes down to one powerful word: leverage. And here it is. This is the magic number you have to remember: 100. A single options contract doesn't just represent one share of stock. Nope. It gives you control over 100 shares. And this right here is what cranks everything up to 11. For a relatively small investment, you get to control a huge number of shares. And this chart just lays it out perfectly. A stock might go up, say, 10%, which, hey, that's a great return. But because your single option contract is controlling 100 shares, that same move can make the value of your option just explode, turning that 10% stock gain into a 300% gain on your premium. That is the power and the risk of leverage. But, of course, anything this powerful is a double-edged sword. That massive potential for gains comes with some very real risk. So it's absolutely crucial we talk about the common traps that beginners fall into. The number one trap I see is people buying those super cheap, far-away options that are about to expire. They feel like lottery tickets, and that's exactly what they are. They're cheap because there's almost no chance they'll pay off. People also just completely forget about that melting ice cube of time decay, or they ignore volatility and they just chase those huge percentages without any real strategy. So let's just boil this all down. Forget all this super complex stuff for a minute. Before you ever think about a trade, just run through this mental checklist. How is the stock price looking? How much time do I have left on this thing? Is volatility crazy high right now? And where is my strike price relative to the stock price? If you can answer those four, you'll understand like 80% of what's going on. So at the end of the day, understanding the mechanics, well, that's just step one. It's an incredible tool for leveraging your predictions about the market. You now know the rules of the game. The real question is, can you build the discipline to master the risk that comes with it?